Hey there, Iggy the Investing Iguana here, and welcome to another exciting episode of the Investing Iguana. In today's video, we're going to dive deep into the recent market chaos that has taken the world by storm. We'll explore what's been happening, why it matters, and most importantly, what it means for you as an investor. The three main takeaways that I will cover would be: A. Understanding the causes of global market chaos. B. Navigating market turbulence with a long-term perspective. C. Identifying opportunities amidst market corrections and sell-offs. So, grab your favorite snack, get comfortable, and let's embark on this wild ride together. First things first, let's address the elephant in the room, the jaw-dropping sell-off in Japanese equities. The Nikkei 225 index, Japan's leading stock market benchmark, took a massive hit, plummeting by a staggering 12%. This sudden drop sent shockwaves through the global financial markets, leaving investors scratching their heads and wondering what on earth was going on. But wait, there's more. The tech-heavy markets of Taiwan and South Korea also felt the heat, with both experiencing declines of over 8%. It seemed like no one was safe from this market madness. However, just when you thought all hope was lost, the Nikkei 225 and Topix decided to pull off a miraculous comeback. These indices bounced back with a vengeance, surging by more than 10% in a single day. That's right, folks, the biggest jump since the depths of the 2008 financial crisis. Exporters, particularly in the tech and automotive sectors, led the charge as the yen weakened against the dollar. Now, you might be wondering, what the heck caused this rollercoaster ride? Well, according to the experts, this market chaos didn't just appear out of thin air. Vasu Menon from OCBC suggests that the seeds of this turmoil were planted gradually, picking up steam in recent weeks. After a strong first half of the year, a short-term correction shouldn't come as a total shock. The tech rout that kicked off in mid-July was the first domino to fall, with big tech companies missing earnings expectations and raising concerns about the profitability of their AI investments. Additionally, investors had been piling into the same crowded trades, making the market vulnerable to sharp movements if those positions were suddenly unwound. Enter the Bank of Japan and its surprise decision to raise interest rates. This move triggered a rapid rise in the yen, setting off a chain reaction across global markets. Investors scrambled to unwind their positions, particularly in the popular yen carry trade, leading to a domino effect that rippled through various asset classes. To make matters worse, lackluster U.S. economic and employment data released last week added fuel to the fire, stoking fears of a potential recession and concerns that the Federal Reserve might be lagging in its efforts to cut rates. Even the mighty Goldman Sachs raised its estimate of a U.S. recession in the next 12 months to a concerning 25%. So, what does all this mean for you, the intrepid investor? Is it time to panic and run for the hills? Not so fast, my friend. While it's tempting to get caught up in the short-term noise, it's crucial to take a step back and look at the bigger picture. Yes, the market has experienced some significant turbulence, but it's important to remember that pullbacks of 5% to 11% are actually healthy for the long-term sustainability of the market. These corrections help to reduce the risk of overextended valuations and provide opportunities for savvy investors to pick up quality assets at more attractive prices. That being said, it's still too early to call the bottom of this market downturn. With so many moving parts and the ongoing momentum of selling, trying to predict the exact turning point is a fool's errand. Instead, the key question to ask is whether the underlying economic and earnings outlook has fundamentally changed. According to OCBC's base case scenario, the U.S. economy is still on track for a soft landing, meaning that there's no need to smash the panic button just yet. The Federal Reserve is expected to start cutting rates by 25 basis points in September, with the possibility of another cut in November as a precautionary measure against a recession. However, if inflation proves to be stickier than anticipated, the Fed may hold off on further cuts until December. So, what's an investor to do in these uncertain times? My advice is simple: keep calm and stay invested. While it's natural to feel anxious during market turbulence, it's essential to maintain a long-term perspective. Historically, markets have shown a remarkable ability to recover from short-term setbacks, rewarding those who stay the course. If you've been hesitant to invest because you thought the markets were too high, the recent correction may present an attractive entry point. By buying during a downturn, you can potentially lower your average purchase price and position yourself for enhanced long-term growth. However, it's important to resist the temptation to try to perfectly time the market. Even the most experienced investors struggle to consistently predict the exact bottom, and attempting to do so often leads to missed opportunities. Instead, focus on building a well-diversified portfolio that aligns with your risk tolerance and investment goals. As Stephanie Leung from Stash Away wisely points out, zooming out and looking at the bigger picture can provide valuable context. Prior to this correction, global equities had already delivered impressive returns of over 13% year-to-date. Even after the recent sell-off, they remain up by nearly 10%. Much of these gains were driven by the exuberance surrounding AI stocks, so a correction can be viewed as a natural and healthy development in the grand scheme of things. Now, let's take a quick look at some of the latest updates and analyst ratings for the companies and indices we've been discussing. As of August 6, 2024, the Nikkei 225 index stands at 27,433.39 points, still down 7.8% from its recent peak but showing signs of stabilization. Analysts at UBS Global Wealth Management believe that the sell-off in Japanese stocks may continue in the near term as the yen strengthens further. However, they also note that the long-term outlook for the Japanese market remains positive, supported by ongoing corporate restructuring efforts and attractive valuations relative to other developed markets. Second, while the current market conditions may seem daunting, they can also present opportunities for those who are willing to look beyond the headlines. By maintaining a disciplined approach and investing in quality assets at attractive valuations, you can position yourself for success in the years to come. Finally, don't forget the power of diversification. By spreading your investments across different asset classes, sectors, and geographies, you can help to mitigate risk and smooth out the ups and downs of the market. So there you have it, folks, the inside scoop on the recent market madness and what it means for you as an investor. If you found this video helpful, be sure to smash that like button and subscribe to the Investing Iguana for more insights, analysis, and occasional reptilian humor. Remember, investing is a marathon, not a sprint, so stay focused, stay disciplined, and stay invested for the long haul. Until next time, this is Iggy the Investing Iguana, signing off.